If you've ever found yourself confused about interest rates when looking at mortgage options, you're definitely not alone. There's lots of different interest rate types out there, and choosing the right one can feel overwhelming. But don't worry, in this video we'll break down the different options. We're going to explain the different types of interest rates you'll encounter and give you tips on how to choose the one that's best suited for your needs. Now first off, let's quickly cover what an interest rate actually is. The interest rate is the amount a lender charges you per year to borrow money, expressed as a percentage. It's important because it determines how much extra you'll have to pay on top of the original amount you borrowed, which is the principal. For example, if you borrowed £100,000 at an interest rate of 5% and you didn't pay any payments off the principal, you'd pay back an additional £5,000 per year. So you'll pay back more than the £100,000, and the total amount will depend on how long the mortgage term is. First up, we have fixed interest rates. This is exactly what it sounds like. The interest rates stay the same for a set period of time, usually 2, 3, 5, maybe even 10 years, and there are some lenders that will let you fix your mortgage payments for the life of the mortgage. The main benefit of a fixed interest rate is that you'll have predictable payments throughout that period, so you don't have to worry about your payments going up if interest rates rise. As an example, if you fix your rate at 4.5%, you'll pay the same 4.5% per year for the duration of the agreed term, regardless of what happens with the Bank of England's base rate or market fluctuations. This can offer clients real peace of mind, especially in uncertain economic times. The downside are that if interest rates go down during the fixed period, you won't get the benefit of this reduction until you come out of the fixed period. But if you like the security of fixed payments, it's definitely worth considering. Next up, we have the variable rate interest. Unlike a fixed rate, this one can change over time. Your lender will set a rate based on either the Bank of England's base rate or another reference rate. And if that rate changes, your mortgage payments will as well. So if the base rate goes up, your mortgage payments will increase. If the base rate goes down, your payments go down. The key thing to remember with a variable rate is it can go either way and your payments will fluctuate. Variable rates can be great if you think interest rates are going to stay low or even decrease. But if you need more financial stability or are worried about potential rate hikes, it might not be the best option for you. Next up is a tracker interest rate. It's a type of variable rate, but with a twist. It's linked directly to an external rate, like the Bank of England base rate. For example, your tracker might be set at Bank of England base rate plus 1%. So if the Bank of England base rate increases or decreases its base rate, your tracker rate will follow suit, and your interest rate will fall or rise accordingly. And like with variable rates, your payments can go up or down, but the difference here is that your lender can't change the rate themselves. It's always tied to an external rate. Tracker rates can be good if you're confident the base rate will stay low or drop, but they also come with the risk that rates will go up, leading to higher payments. Next, look at discounted rates. This is a type of variable rate where your lender offers you a discount off their standard variable rate for a set period of time, often 2 or 3 years. For example, your lender might give you a discount of 1% off their SVR, their standard variable rate, for the first 2 years. And during this time, your rate would be lower than the lender's SVR, but it can still change depending on the lender's changes to their own SVR during that period. The downside here is that, like the variable rate, the lender is often in control of the standard variable rate and can make changes at any time. So this can be a good option if you're looking for savings in the short term, but if you need financial stability or have concerns about potential rate hikes, it may not be the best option for you. So, how do you choose the right interest rate for your situation? The best option for you depends on a few factors. If you're planning to stay in the home for a long term, a fixed rate mortgage could be a great choice for stability. But if you think you'll be moving soon, a flexible tracker or discounted rate might give you more flexibility. Do you prefer predictable payments, or are you okay with some potential fluctuations? Fixed rate offers security, while variable and tracker rates come with some uncertainty. Think about how payments fit into your overall budget. Are you looking to pay off your mortgage quicker? A fixed rate mortgage might help you stick to your plan, but if you want to take advantage of lower rates in the future, a variable or tracker rate might be the right choice. Fixed, variable, tracker and discount each comes with its own pros and cons, and the right one depends on your personal situation, your goals and comfort level with risk. We would always recommend speaking to a whole of market mortgage broker. They'll be able to fully understand your circumstances, they understand the market, and they'll be able to recommend the most suitable product for yourself.